Hi, welcome back. In the last few sessions, we've laid the foundations for value investing. After the introductory session where we talked about the Ben Graham and the Warren Buffett effect on value investing, we talked about passive value screening, where you look for stocks that trade at low PE ratios or low price to book or have high dividend yields on the assumption that they will mean revert, that they will become better investments and essentially earn you a higher return. Then we moved on to contrarian value investing, where you look for stocks that have fallen off their peaks, have had something bad happen to them in markets, but have had no good reason for that bad happening. In other words, their fundamentals have held up, and you try to invest in those companies. In this session, I want to focus on activist value investing, where you actually go into companies and change the way they run and hope to harvest the returns as a consequence. And in particular, I'm going to look at private equity, which has become the player that drives a lot of activist investing. Before we look at private equity, it's worth noting that activist investors come in multiple versions. There are lone wolves. Now, Carl Icahns, the Bill Ackmans of the world, who, even though they're vehicles that they use, they're individuals who push for change. There are groups of institutional investors who call themselves activists, who go in and push for change. CalPERS, the California Pension Fund, early in its lifetime was an activist investing force. And you, of course, have private equity and hedge funds who go in and target companies and try to change them. The key difference between activist hedge funds and lone wolves is rather than push to change the management, replace them, you often work with the management in taking the company private and then try to change the company in conjunction with the management in place. Lone wolves, institutional investors, activist hedge and private equity funds. Now let's focus in on what activist value investing is and what might allow it to work and what sometimes can cause it to break down. Here's what you do in activist investing. You target a public company where the status quo value reflects how that company is run right now. And implicitly you're assuming this company is not run right. It's not run well. And you think it could be worth a lot more with different management in place, changing the way the companies run, different projects, different financing, different dividend policy. Let's call the first value the status quo value, the value of the company as is, the optimal value being the value with the changes put in. There's a gap between the two. You as the activist investor are trying to take advantage of that gap. By doing what? By coming in and changing the way the companies run, and then claiming the difference between the optimal value and the status quo value. Of course, you might not succeed at getting the management change, so you have to put in an expectation of a management change in to come up with that difference. So the essence of activist value investing is changing the way a company is run. Now, before we embark on those, let's take a look at the motives that private equity investors often, or activist investors, bring to the table when they target companies. Much as I've talked about changing companies, the biggest single motive that activist investors cite for targeting a company is that it's undervalued. Why might that be? Well, if you have an undervalued company that's badly managed, you have two things working in your favor. You can fix the management, increase value, but you also have the undervaluation working in your favor. But you look at the changes that activist investors plan to make, a big chunk turn out to be capital structure changes. You want primarily increasing the amount of debt that a company carries. It could be changing strategy, entering new businesses, exiting other businesses. It could be the sale of the target or pieces of the target, or it could be changes in governance, management, board of directors. Okay? Now, as you look at those, you can already see what a typical target company is going to be in an activist investing mission. A typical target company will tend to have higher free cash flows, high positive free cash flows. Why? Because you need those cash flows to service your debt, especially if you're borrowing money to do the investing, to take over the firm. High free cash flows. Second, the company needs to be cheap. Here again, your measure of cheapness might be simplistic, low PE ratios, low EV to EBITDA. So typical target companies tend to have high positive free cash flows, tend to be cheap, and tend to have potential for operating improvement. You're saying, how would I know? Your company's margins are well below the margins of your peer group. Returns on capital are well below the cost of capital. High free cash flow, cheap, and potential for operating improvement. Okay? Now, of course, once you get into the firm, you need to change the way it's run. There's a lot on this page. I won't go through every single one of them. But essentially, here are the 5 questions I would ask about any company. And I could be an activist investor or an outsider. First is, how well does this company manage its existing investments? Because you could bring in cost cutting and divestitures to manage those assets better. Are you investing optimally for future growth? If you're in a business earning less than your cost of capital, you're in a bad business, you shouldn't reinvest. In fact, reinvesting less is better than reinvesting more. If you're in a good business, maybe reinvesting more will increase your value. Third, is there scope for more efficient utilization of existing assets that could increase your margins? Fourth, are you building on your competitive advantages? Your competitive advantages show both in your profits and returns, as well as how long you can grow at a rate higher than the growth rate of the economy. And finally, are you using the right amount of debt in funding the firm? With young growth firms, your focus is going to be just on two being, are you investing optimally for growth? With established growth firms, it's going to be 2, 4, and 5. With mature firms, your focus might be on 1, 3, and 5. So depending on where your firm is in the life cycle, what you do to extract value, to make it more valuable, can be very different. Now that's the promise, that activist investors will go into these target companies and change them. Let's see what the actual records show on what activist investors do with these companies. On the governance side, here are some of the changes that come about when a company is targeted by activists. Boards of directors tend to become smaller and meet more frequently after activist buyouts. More directors are picked for their expertise in the target business. You have less directors for show, more who know that business. In terms of top management, the likelihood of CEO turnover increases at firms that are targeted by activists by about 5.5%. Far more CEOs at firms that are targeted get replaced than in firms that are not targeted. And CEO compensation decreases for the most part after an activist targeting and becomes more equity focused as opposed to cash. So there's a governance change. On asset deployment, less money is reinvested back. But there's little evidence that activist investors just strip companies down to nothing. They do reinvest less, often for good reasons, because you're in a bad business. And when growth firms are targeted by private equity investors, there is no evidence of a drop-off in R&D or a decline in what the company has to do to deliver that growth. So much as we have this prototype of private equity investors as stripping down companies, and that is definitely true at some private equity transactions, for the most part, private equity investors tend to refocus investments in existing businesses. As part of that redeployment of assets, there are divestitures, usually of businesses that don't fit into your core. So in many ways, companies, after being targeted by activist investors, go back to their core businesses. And if they go into new businesses, they sometimes do, it is to augment what they do, augment their strengths. So on the investment side, there are changes. On the finance, on the profit, and those changes show up in profits. If you look at the margins in the years before and after an activist buyout, profitability improves in the 2 years after. So the two latter columns are the after, the two columns in front are the before. You can see that profitability improves. So activist investors come in, they sell off assets that are non-core, they focus reinvestment, and they do cut costs to increase profitability. Now, on the financing side, it is true that there is more borrowing after the deal. And if there's a weak link in activist investing, it might be the assumption that higher debt is always better than lower debt. So if you look at the debt ratios for companies in the years before the target and the years after, it's undeniable that there's an increase in debt after an activist targeting. Some of that is because of limited capital. The other reason is activist investors hope to benefit from the leverage effect in terms of earning higher returns. So there's more debt after funding, default risk tends to increase, and existing bondholders can be adversely affected because the existing lenders lend to a safer firm, and if they're not protected, they can be hurt after a private equity transaction. And finally, on dividend policy, there is more cash return, both in the form of special dividends / buybacks, In some cases, there is a stripping of the assets to pay these dividends. That's often viewed as a negative on private equity, and in some cases it can be, if the assets being stripped are essentially assets that should not be stripped. The changes in governance, companies have smaller, more accountable boards, and there's more management turnover. Changes in the asset base, assets get added on, divested, changes in financing, more debt, and increased dividends. So activist investors do make a change. But let's not overestimate how successful they are. If you look at the success rate of activist campaigns, it's pretty low. If you take, for instance, sale of a company, only 32% of targeted companies actually sell. Operating restructuring, about 34.78% of companies restructure. More dividends, only about a sixth of all companies pay more dividends. So you can have a company target an activist investor, but in many cases, the activist investors either give up or they give in, and there's very little change. Overall, if there's a critique of activist investing, it doesn't have enough of an effect on the companies. And much of the gain seems to come from the price rise that comes about after they've targeted the company. They often get called on their bluff and they can't carry it through. As for the question of whether activist investors make money, this study looks at the returns on stocks that have been targeted by private equity investors around the date of the targeting. Day zero, the 13D filing is when you know they've been targeted. First thing you notice, the stock price starts to drift up in the days before the filing. Information is leaking out. I will leave it at that. Insider trading perhaps follows, and the stock price drifts up. But clearly there is a positive effect on the stock price from being targeted by activist investors. The question is, if you see the drift that happens after the announcement, is can you and I take advantage of this drift? Perhaps. You buy stocks after they've been targeted by activist investors. The announcement has been made. There's still a little bit of a drift, but it's not big, and there's enough noise in it that you can still get hurt as an investor. So if you look at private equity, and how it generates value from a transaction, in addition to all of the changes we talked about and the increase in the value of the equity, it is true private equity investors also collect money in the form of management fees. In fact, there are many private equity deals where everybody else loses money, but the private equity player ends up making money because of the management fees. But management fees are a key component of how they make money, but making your equity stake more valuable is the bigger payoff. If you can buy a company and quadruple its value before you flip it back, and the way you exit can be either by taking the company public again or selling it to a public company. That's the way you get big winners. So management fees are part of the game. But to be big winners, private equity has to actually change companies and get people to pay more for these companies. Now, this is actually from a private equity player, so take it with a grain of salt of how private equity generates the returns it does. So you can see the build-up. There's the market return it made as a passive investor, and there's a timing effect where private equity enters this company at the right time. There's a sector effect. You pick the right sector. There's a leverage effect. The debt helps you. It brings you to comparable return. And then you see the red alpha. The presumption in this graph is private equity players are special. They add to your returns. The red is the additional return they deliver because they're skillful. For a long time, private equity had that reputation of being an alpha generator. But here's the bad news. Things are starting to change. In this graph, you look at private equity versus public equity. Public equity, of course, is buying stocks in the market. Private equity is going through the private equity players. The red column is the private equity. In the early part of private equity's life, and this graph starts in 2002, but you could go back to in the 1980s and 90s, private equity consistently delivered returns, at least in the aggregate, that exceeded public equity. They focused on the right companies, they made changes, there was a payoff. That started to change. If you look at 2017 through 21, and in fact, I have the data through 2024, private equity at best is staying on par with public equity, and at worst is falling behind. In fact, if you look at the alphas, what you earn over and above, you see the dropping off of alphas over time from private equity. Now, This graph goes through 2015. If you extend it out to 2020, 2021, the alphas have very quickly drifted down towards zero. Private equity has increasingly becoming a game where generating additional returns, excess returns, has become difficult to do. But even in its glory days, private equity has always been a game where the returns are diverse. Put simply, even in the glory days, it's not like all private equity funds delivered more than the market. It's that the biggest winners delivered a lot more. And you can see that in this graph where I graph out with each type of private equity investor what the best returns, the worst returns, and the median returns. The median returns are actually very ordinary. It's the very best players in the game who are delivering those high returns, and they're the ones who make the news, and then you form your views of private equity based on those biggest winners. Not every private equity player is a KKR or a Blackstone. In fact, most of them are very ordinary investors. And even the KKRs and Blackstones, the way they make money doesn't come from winning on every single investment. The biggest winners within their portfolios carry their portfolios. So private equity has become increasingly a zero-sum game, a game where you deliver returns that you expect to deliver. The biggest winners might still remain there's some continuity in this game, but the biggest winners still stay winners because their best deals deliver enough money for their portfolios to do well. Ultimately, though, I think the fading of private equity, some of it can be traced to the fact that private equity today is so much bigger in terms of capital invested than private equity 10 years ago, 20 years ago. We might have oversold private equity to investors and in the process attracted so much money that the basis for alphas might very well have dissipated. But if you decide to play this game of being a private equity investor, here's what you need. First, you need to have lots of capital. You can't be a private equity player with $100,000 in your portfolio. You need hundreds of millions of dollars. Otherwise, what company will take you seriously? You need to know the company you're targeting well in terms of its culture, in terms of its management, in terms of the change you want to make. You need to understand basic corporate finance. What does that mean? You need to know what separates good projects from bad projects, when more debt is good for you and when more debt is bad for you. You need persistence because when you initially push at a company to make a change, incumbent managers will say no. You need to be persistent enough to be able to keep pushing and capital to keep doing it. And finally, you need to do your homework because this is a long-term process. And the very best private equity investors stay in the game. They stay pushing, they get the change, and they reap the benefits. I hope you found this session useful, and I thank you very much for listening.